Hey everyone, so my name is Zach Vines, and what we're going to go over today are several different depreciation methods, going over straight line depreciation, the double declining method, and then sum of years depreciation. So to kind of just touch on the point of depreciation in the first place is that basically we have some asset that we purchase, some long-term asset, could be equipment, could be a machine, might be a vehicle, something that's going to serve us for a long period of time, often that costs a lot of money, that instead of us entirely expensing the cost of that asset at one time, we allocate the value of that asset over a period of time to recognize the benefit we get out of it instead of just expensing it all at once. We recognize the expense in the period that we receive the benefit for what we purchased, and thus we're allocating the cost of that asset over a period of time. And so what happens is that, let's say we bought a piece of equipment. The first thing you do is that when you buy your asset, you're going to debit or increase the equipment account by the purchase price of the asset, and then assuming that we bought it in cash, you would credit or decrease the cash account by the amount of that. But notice that we never recognize an expense. Even though that oftentimes equipment's going to be very costly, probably thousands and thousands of dollars, we don't recognize an expense and it doesn't hit our net income, which logically we should have something that impacts that at a point in time. But again, the way we do that is instead of doing it all at once, we allocate that over a period of time by depreciating it. So what you do next is that you depreciate it using just some method. What we're going over are three different methods between straight line, double declining, and sum of years depreciation. But in the end, you're going to end up depreciating the same amount no matter which method you use. But depending on the method you use, you're going to debit your depreciation expense by whatever amount it is given that method, and credit your accumulated depreciation. So one thing I want to point out is that the accumulated depreciation is what's known as a contra asset, meaning that it holds the opposite balance that an asset normally would. Think that contra means contradict, and so normally an asset holds a debit balance. Well, a contra asset actually holds a credit balance. So in order for you to increase the balance in your accumulated depreciation, you actually credit it, and it basically offsets the value of your asset, or at least it shows you how much you've depreciated on that asset up to a point in time. It's the amount of depreciation that has accumulated, and thus your accumulated depreciation. So let's first go through the straight line method, because I think that's the one you're going to see the most often. It's the simplest one out of the three we're going to go through, and it's very straightforward, where the formula for the straight line depreciation is you take the cost, however much the asset cost for you to purchase. Subtract out what's known as the salvage value. Now, the salvage value is basically a scrap value. It's what you think you can get by the time you're done using that asset for the number of years you believe you're going to use it. You say, okay, I bet I could sell this asset at the end of its useful life for however much money. That's what you put in for your salvage value. And you take that, and that's known as your depreciable base, is that numerator right there, the cost minus the salvage value, and you divide that by the number of years you think you're going to get out of that asset, the useful life of it. And that will give you the amount that you depreciate of that asset per year. And under the straight line method, it's going to be the same depreciation expense for the entire life of the asset, hence why it's called straight line, because it's simply the cost minus salvage value divided by the useful life gives you an even depreciation expense throughout the useful life. And so for a quick example, and this is actually the example we're going to use for the next two methods as well, so keep that in mind as we start to go through those, that this is the situation we will be talking about, is let's say we buy an asset for $60,000 and it has a 5-year useful life and a $10,000 salvage value. We'll just simply plug into the formula. We're taking our cost, what it costs us to purchase the asset, the $60,000, subtract out the salvage value, which is your $10,000. It's going to give you $50,000, divide it by your 5-year useful life, and you're going to depreciate $10,000 per year. So the way that journal entry would look is that originally you would debit your equipment and credit your cash by the full $60,000, since that's what you paid for it. And then for the depreciation expense, this is going to be the same journal entry every single period that you depreciate this asset. You're going to have $10,000 debit depreciation expense and $10,000 credit accumulated depreciation. So I think that's fairly straightforward as far as straight line method goes. Hold on to that, because that's going to be very relevant for the double declining method, which we'll do right now. Okay, so now we're talking about the double declining depreciation method. So we're just going to go through the steps, and then the exact same example we had before, where we had our cost of $60,000, salvage value of $10,000, useful life of 5 years. We're going to just do that, but exactly for the double declining depreciation. So to start off with, the first thing you want to do is find out what is your straight line rate. So when we did our straight line depreciation, there was a rate that we applied to our depreciable base so that we knew what to depreciate each year. So the way we would do that is we would take just 100% and divide by the useful life. That would give you your straight line rate. you take that straight line rate and you multiply it by 2, and that's going to give you your double declining rate. So once you have your double declining rate, that's really what you need to do the double declining depreciation, because from there you multiply it by whatever your book value is at that point in time, and that's going to give you what the depreciation expense is for that year. So real quick, the book value that you multiply is basically the undepreciated portion of your asset at that point in time. So it's the cost of the asset minus the total accumulated depreciation you have to that point. So if I have that $60,000 asset at the beginning, my book value is $60,000 because I haven't depreciated any of it yet. But by the time, let's just make up a number, let's say I've depreciated 20,000, let's say, I don't know, we did 10,000 a year, and thus we're at 20,000. If we started with 60 and then we're now down to 20 accumulated depreciation, your book value would be 40,000. So you'll see how that works and how we keep up with that in this example right here. So two things I want to point out really quickly is that when you're applying your double declining rate, so when you do your double declining rate times your book value, ignore salvage value. So under the straight line method, we would have to take our cost minus our salvage value and then divide that by the useful life. Here, double declining doesn't consider the salvage value whatsoever, at least when we're applying the double declining rate. So don't subtract that out like you may do under the straight line method. And then as you're doing this process, you go through these steps like we just laid out, but you have to be very careful that you don't depreciate your asset below its salvage value, because that's what we're going to sell it for, so we don't want to depreciate below that value. And let's say we don't have a salvage value, if you continue to do this calculation, you may end up depreciating it to a negative value, so you do it below 0 would be the standing book value. Don't do that either. If that's the case, just make your depreciation the maximum amount you could do so it doesn't make your book value fall below your salvage value or below 0 overall. So for this example, it's the same one like we just discussed before. So going through those steps, you just take 100%, divide by the number of useful life, the amount of useful life, so 5 years here. 100% divided by 5 gives you a 20% straight line rate. Multiply 20% by 2, that's your double declining rate. So from there, we're just going to take our double declining rate and multiply it by the book value at that point in time to get what your depreciation expense is for that year. So you can see for year 1, our standing book value just is the $60,000 we have from the get-go. You're going to multiply that by the 40% double declining rate, and that's going to give you a depreciation expense of $24,000. So overall right now, assuming we don't have any other assets that we're depreciating, our accumulated depreciation is this $24,000 right here, because it's the only amount that we've depreciated so far. So for just 1 year of $24,000, our book value would be the cost minus our accumulated depreciation, or $60,000 minus $24,000. So our book value is $36,000. And notice that the book value funnels into the book value for year 2. So that $36,000 we multiply by that consistent double declining rate, and we get a different depreciation expense, $14,400. So my accumulated depreciation is going to include an extra $14,400. So I take my current book value, subtract the extra depreciation that I've done, and that leaves me with $21,600. Another way you could do that is go, okay, what is my overall accumulated depreciation here? It's going to be these two added together, and if you subtract the sum of these two from your $60,000, it also gives you your $21,600. So you really just do that for every single year, but one thing you have to be careful of is once we get to year 4, so we have our $12,960 right here, the book value from just doing these calculations, funnels into year 4. Now, we're going to do the same calculation, multiply it by 40%, and what we get right there, I believe, was 5,184. I can't tell because I exited out, but I believe it was 84. But if we do that, notice that if I take 5,184 off of 12,960, that's going to push me below my salvage value of $10,000. I don't want to do that, and so what I do instead is take the maximum amount of depreciation I can so that I don't fall below my salvage value. And so if I'm sitting at 12,960 and my salvage value is 10,000, I can only do that 2,960, which is the difference between these two numbers. And then for year 5, even though my calculation would warrant me having a 4,000 depreciation expense, I'm just not going to recognize any depreciation that year because, again, I can't depreciate it below its salvage value. So I'm just going to leave that blank. But you can see that when you add up all of your depreciation right here, it's going to be the same amount as the method that you did for the straight line method. It's still going to be that exact same amount. So no matter which method you do, it's still going to depreciate the same amount. It's just the way it does it is a little bit different. And you might also hear double declining being known as an accelerated form of depreciation, which makes sense because under straight line, it's the same amount each year because it's just cost minus salvage value divided by useful life. But here you can see that it makes the depreciation expense larger on the front end, and then it gets smaller and smaller and smaller as you go along. So that is the straight line method, the double declining method. So let's wrap everything up with the sum of the years depreciation method. Okay, so finally we're going to go over the sum of years depreciation method. And so again, on the left side, we're kind of listing out what you do sort of in a general sense, and then we're going to do that exact same example we've been doing, cost of $60,000, salvage value of $10,000, useful life of 5 years, to show you how it works for the sum of years depreciation method. So what you do is that you find this applicable percentage and multiply it by your cost minus salvage value. So to start off with, the way you get that applicable percentage is that for a particular year, you see how many remaining years you have left for that asset. Take that number and divide it by what's known as your sum of years digits value. And so when you divide that, you get your applicable percentage. You multiply that applicable percentage by this same number every time, which is going to be your cost minus your salvage value, so that same amount, but with a different percentage based on your remaining years changing, and that's going to give you your depreciation expense for that year. So for the denominator in your remaining years divided by SYD, the way you get that SYD, there are two ways you can do it. Both are fairly simple. I would say the first method's better when there are a lot of years to do, or the second method's easy if you have maybe up to 5 like we have right here. But basically, you can just fill in the formula that we have first, which n times n plus 1 divided by 2, where n is the estimated useful life. So if it's, we'll show the both methods right here for a 5-year life, but you can simply plug the estimated useful life in for n, or however many years there are, just add each year onto itself, which is kind of weird to verbalize, so I'll just show you what I mean in a second. Let's go ahead and go through this example. So the first thing we're going to have to do is come up with our applicable percentage. The way we do that is the remaining years for a particular year divided by your SYD. So let's go ahead and find our SYD. Two ways you can do it is to plug 5 years, because this is a 5-year useful life, for n, so 5 times 5 plus 1 divided by 2, solve for that, and you're going to get 15. So you either do that, or since it's 5 years, just do 1 plus 2 plus 3 plus 4 plus 5. And if it was 7 years, you do the same thing, but then add in plus 6 plus 7. So, the number of years, you add it to itself, however you want to word that. But there's a pretty good example to give you an idea of what I mean. So at that point, we're just going to set up our table talking about the 5-year useful life. So I have 5 different years right here. I'm going to take my remaining years divided by my sum of years digits. So for year 1, I have 5 years left on that asset. So I take 5 and I divide it by that consistent 15 that I just found out for SYD. By year 2, there are only 4 years left. So I do 4 divided by 15, 3 divided by 15, and sort of count down each time. Basically, the first one you should put in, the numerator will be the number of the useful years that you're going to get out of it, the useful life. And then it'll go all the way down to 1, which is going to be the last year you depreciate it for. So you're going to take each of those fractions, so this is 1/3, and you actually crank out these calculations here, take that percent, multiply it by cost minus salvage value, which in this case was 60,000 minus 10,000, so just 50,000 all the way down, and you're going to get these depreciation expenses right here. So for year 1, you're going to debit depreciation expense and credit accumulated depreciation by the 16,666.66 repeating, and each of these values are the depreciation expense and accumulated depreciation journal entry values for each of those years. So thank you all for watching. You can see that it's really just formulas you have to plug into, lay your framework, have it set up, plug into the formulas, and you'll be good to go. So thank you for watching, and I hope that helped.